All right, welcome everyone to another episode of Daily Rates Live with the Mortgage Calculator. We are a lender and broker in over 20 states with over 200 licensed loan officers that would be happy to help you out. And what we do on the show every day is go over our live mortgage rates programs and then do a deep dive into a specific topic. So today we're going to be talking about our second homes, aka vacation homes or vacation rentals. So a lot of different ways to cut that up. I have some specific examples here of our most common requests so we can go over big details. So let's go ahead and get started today. Again, my name is Nick Hershey. I'm the president of the Mortgage Calculator. We are a lender and broker in over 20 states with over 200 loan officers. And if you'd like a full itemized loan estimate for anything you see today, please get with one of our team members. They'd be happy to help you out. Let me go ahead and my screen and we'll check out the rates for today. So as we do every day, we want to make sure we check out the market in general. So if we see here, the is going down a little bit today. So you see we had a little bit of spike the other day. A lot of ups and downs. Generally, it's coming down a little bit. Hopefully, it continues. But we always want to put things into perspective. So, of course, during the week, during the markets, downs every day. But we want to look at a larger time period over here to see the general rates. And you see you're pretty much at 1 year lows. Been a little bit up and down over the last few months. But we're much lower than we were 1 year ago, which is great news for all of our borrowers out there. Now let's get into our live. So I just refreshed this just a few minutes ago. These are our live rates for this morning for all of our partners. And we set up a standard scenario, the best rates and pricing across all our different options here. And we compare it with the same scenario. So a single family home, 500,000 purchase, 300,000 loan amount, 60% loan to value, 760 FICO credit score, estimated 40% debt to income ratio. That way we can get pricing on all these different options. So first up, our standard conventional primary home. What you think of typically when you think of a mortgage, a standard mortgage loan comes in today, 5.875 rate, final APR 6.135. Hopefully that comes down just a touch today as we see the rates were trending downward. And if our borrower doesn't qualify for a conventional option, typically the next option we want to look at is has more leniency on credit issues and higher overall debt to income ratio, but does require upfront and yearly mortgage insurance. So FHA comes in today at 5.25 rate, 6.139. So as typical, FHA is going to be a little more expensive than conventional. We're apples to apples there, and that's what the APR allows us to do. And for all our eligible vets and active service members and surviving spouses, VA programs are amazing. VA comes in today, 5.375. Final APR 5.627. So even though the rate final APR is much better for our vets out there because there are much less fees on a VA loan. So when you compare APR there, definitely typically the best option. And for our borrowers in those USDA eligible areas, the rural areas of the country that are eligible and their income is eligible, USDA is a good option to compare. USDA comes in today, 5.125 rate. Excuse me. APR comes in at 5.802. So customers shopping in these areas are going to be comparing it typically to. We see here USDA is a little bit better in these examples with all the fees included. And once we start getting into our non-QM options, these are where we calculate our outside the box solutions, which is what we're going to be talking about today for our second homes and vacation rentals. And our non-QM alt doc option for we're going to be comparing this to a conventional option if our borrower doesn't qualify for conventional or any of the standard options here. We may need to use alternative docs, especially for our self-employed borrowers, statements, 1099s, P&Ls, etc. So to use alternative docs here, we can go with our non-QM options, rates as low as final APR 6.272, higher than conventional, which is typical for the markets here. To use alternative docs costs just a little bit more. And we can use alt docs on our investment properties as well. Rates come in, final APR 6.448. And we compare that to our conventional investment properties, same rate, 6.125, APR 6.438. Typical here tracks almost exactly like this every day. Conventional is just a touch cheaper than our alt doc options. But what we love here at the calculator, at least I love personally, is doing our DSS loans. No income or employment needed. We simply use the estimated rents from the rental property here, in this case, to a DSCR ratio if the rents exceed the payment, aka the property cash flows. That's a higher, which is what's used for all these estimates. And we have a 3-year payment penalty applied to this, which is standard here. Rate CR option 5.999, final APR 6.222, absolutely smoking. Conventional, which is amazing, as well as our alt. And we can add a 5-year prepay to sweeten the deal. Rates come in 5.875, amazing. Final APR 6.93, again, absolutely blowing water. That's why we love our DSCR options. And we can also add no prepayment penalty, as some states don't allow it. Some investors don't want it, no problem. Rates come in today 6.125. Final APR 6.448. Again, just a touch higher than conventional. DSCR programs are. And we have a ton of other options, second mortgage, but tons of options here. If you check out our live rates page, you can get a actual quote there on any of our programs. But let's get into our deep dive topic for today and see which of these programs that we go over every day is going to be best for a vacation home or second home. And I always want to pull up an example. So I'm here in the Fort Lauderdale area, so just found a nice home that looked I guess I would say vacation ready rental, vacation ready or rental ready. So here we also have a home that notice is at a higher price, 1.15 million, which is going to exceed our conventional limit. I wanted to make sure we pulled up our typical request. So typically when we have a customer come in to request a second home or a vacation home, it's typically so in this case, we're going to be unable to use the conventional programs because the conventional loan limits are going to max out at 832, I believe, next year. So a little bit more than last year, but not quite enough to finance a lower down payment option here for a second home at this purchase price here for this one that's for sale. So again, it's nicely furnished. Looks like you could either rent it a vacation rental or obviously move in there. So these are. And the first option here is going to be if we're to purchase this as a standard jumbo or to exceed the loan amount limits of a conventional or a standard second home purchase. So it's going to be our option here for second homes using our non-QM options. We do have some prime jumbo options, but that's not what today's show is about. So of course we could have quoted prime jumbo. This is a standard non-QM and 15% down. And for that exact house we looked at, some things to note. Remember, second home, also known as a vacation home, a second primary, obviously needs to not be in the same city you're in. There's a lot of different stipulations. The biggest one here that we're always going to be talking with our borrowers typically about is how many days can you stay there. So technically 14 days you need to stay there per year. Can't rent it on an annual lease if you're calling it a second home. But if you do only stay there 14 days a year, you're allowed to rent it for the other days of the year as a vacation rental. So very popular thing for people to get a nice home, for example, like we just looked at there, maybe in Florida, on the beach, whatever it is, and use it for 14 days per year. But if they don't use it for 14 days per year, we must reclassify it as an investment property. And typically we're going to use our DSCR options, especially for those short-term rental investment properties. So just keep that in mind. If you're not going to occupy, can't call it a second home. Very common source of confusion for borrowers out there. But now let's get into the rates. So if we want to go non-QM, full doc, a second home purchase, 15% down, the lowest down payment, pretty amazing rate, 6.75 rate costing 2.375, and a 7.499 rate. Actually, a little bit of lender credit there, a 0.5 lender credit, almost $5,000 in this case. And again, this is going to allow us to get a loan amount of almost $1 million in this example, putting 15%, which exceeds the conventional limit. That's why we can't quote conventional limit. And just the other details of the loan. Remember, we use the 760 FICO like we did in your estimates, 85 LTV, second home, and we did use full doc. Now, the next quote up here is going to be if we had to switch it to a, and let me go ahead and refresh this one. Now, if the borrower not occupy, that's what we assume too. Hey, I don't think we're going to occupy it 14 days of the year every year, but we still want to buy it. No problem. We just have to make sure we classify that as an investment property. Investment property, same program, non-QM full doc, 30-year fixed, standard option for our non-QM options, 15% down, we can still do that. And full doc allows us to do a short-term or long-term rental property. So it's still an investment property. We can still capture that from the rental, but loan. So we're still going to have our standard income as well. When we switch to a DSCR loan, remember we have to be very cognizant of the rents that we're going to use. Have for income is the rent. But in this case, we're going to do full doc. Hopefully our borrower has plenty of income. And we can also, because we classified it as an investment property, capture the income from this property, whether it's short-term or long-term. Typically, we're going to have to use long-term rents. And the rates here, similar rates, 6.875, a little more cost, 5 discount points at cost to get it down that low. And our 7.5 rate here when we're an investment property, still costing 1 point in discount points here. The almost $1 million, get the $1 million loan amount, put 15% down, pretty amazing here. And their assumptions were the same. Now, the next option is our DSCR. So I think this is, I have that up twice. So our DSCR option here is our first option, 30-year fixed standard DSCR. We can still do 15% down, and we added a 5-year prepayment penalty, which is standard for these DSCR options. Now, the tricky thing here is this does technically allow long or short-term rental income. We have to document it very specifically. So if we need to use that short-term rental income to meet the DSCR ratio, it's going to be a little bit tricky. Cover the full payment, PITIA, based on estimated rents, whichever estimated rents we can use, improve, and document with the appraisal. So in this case, we can still use the full 85% LTV max. And this one is kind of pushing all of the limits case. So definitely just be aware of that. But since we added the 5-year prepay, the rates are actually better. So this is a little bit counterintuitive to a lot of people. It's a 6.749 for 3.35 discount points at cost. And we can even get a lender here, 7.99 rate gets us credit. So when we add those prepayment penalties, it really sweetens the deal for our investors or banks out there that are actually dealing with the loans and makes the pricing much more attractive. So in this case, again, 15% down, DSCR loan, no income or employment information needed. We simply need to deal with those estimated rents. Now, the one thing here is our monthly payment. So our estimated rents need to cover payment and taxes and insurance. So not only are we going to have this standard principal and interest payment here, but we're going to add our tax and insurance, which I don't have estimates for at the moment. Always going to be our concern. Now, the way to get around this is to use an alternative. So the next option is our 30-year interest only option for 15% down still with the 5-year prepay for that exact house. And this will allow us to use the interest only calculation. So what we're going to be looking at here is a little bit more expensive pricing, but we're going to be able to use a low. So in this case, the fine print here, it's a 10-year interest only period. And then after the 10 years, since it's a 30-year fixed loan, it converts to a 20-year amortized loan after that 10-year interest only period. But fortunately, since we're doing interest only for 10 years, we can use that for our qualification. So in this case, down as low as 7.249 rate for 3.225 discount points at cost. But look how much that lowers our payment. So since we're going interest only payment and a little bit decent rate there, $5,905 is now our new payment we have to cover. So say the appraisal came in for payment under $6,000, we're going to have to get to interest only, and we're going to have to buy it down as much as we can to make that work. So you see a lot of times to look at the rents. Once we get the rents back, make a few adjustments to hit that. For example, we're trying to hit under 6,000. That's the money spot. This one won't work. Won't get approved, even though it's only $7 short. Won't get approved CR loan because it's not hitting the ratio. This one, we are under that 6,000. If that 6,000 is our estimated rents, we need to get just under there. So that's how we approach that. So a few different ways to attack I did have another example that I was going to do for 20% down, which would obviously be better rates and pricing. Typically, going to be the adjustment we might have to make. So back, and unfortunately, we have to get under 5,000 for the monthly payment. there's not going to be any options to keep this high percent down, low down payment, low loan amount. We're going to have to go probably down to 20% down to 80% loan to value in order to this DSCR ratio or this payment to improve the DSCR ratio. So very tricky there once we get into the weeds with the DSCR, but also very flexible. We can use long-term or short-term rents as long as we can document them, and no income or employment needed. But if we're just looking to do a standard vacation rental at our second home when we are truly occupying it 14 days per year, we have those options as well. And you can even go conventional if under those loan limits. We'll do that in a lot of different ways to cut up a vacation rental or a second home. Definitely a very popular request these days, as a lot of people are buying second homes and looking to capitalize on short-term rent, Airbnb, to hopefully maybe even make some income and have that second home available when they need to vacation. So anybody out there, I don't see any questions. If you have any questions or want to get a full itemized loan estimate, please reach out. Our team would be happy to help out, send you a quote for any of the programs, rentals, DSCR, all the cool options we have. But I hope everybody has a great holiday. I don't see any questions for today. We'll be back later this